right, welcome to Iron Financial. We're here to help you forge a stronger portfolio. How do we do that? By cutting through all the market noise and hammering down on the cold, hard facts. Today, we're putting Hasbro directly under the microscope. Their latest earnings report just dropped, and honestly, the stock didn't really do much. It just sat there. And that tells you the market is confused. So our job today is to tear this report down to the studs, figure out what's really holding this thing up. Are they actually building a financial fortress here, or is this whole thing just a well-painted facade about to crumble? Let's get into it. Okay, whoa, hold on a minute. Before you start throwing around revenue numbers and operating margins, we have to address the massive elephant in the room. This is the one fundamental question you have to ask yourself before anything else. For decades, when you heard the name Hasbro, you thought of toys, right? G.I. Joe, Transformers, Play-Doh, that was the brand. That was the entire investment thesis. But you look at their results today, and a completely different story starts to emerge. So the question the market is wrestling with is this. Is Hasbro a legacy toy company with a profitable little side hustle? Or has it fundamentally transformed into a high-margin gaming behemoth that's just being dragged down by its own history? I'm telling you, the answer to that question changes everything.
You're absolutely right. And that identity crisis, it is written all over their financials. It's practically screaming from the page. This brings us right to the core conflict in the numbers. When you crack open this earnings release, you're immediately hit with two totally different, totally contradictory stories. It really is a tale of two reports, one that covers the fourth quarter and one that covers the full year. And frankly, they look like they could be for two completely different companies. So let's break down these conflicting signals piece by piece. Okay, so let's focus on the image on the left. This is the fourth quarter. Now, if this was the only piece of paper you saw, you'd be telling your broker to back up the truck. I mean, look at these numbers. Net revenue, up a staggering 31%. That is a massive beat, especially in the tough consumer environment we're in. Now look at operating profit, up over 100%. Net earnings, through the absolute roof. Their core operational earnings, their EBITDA, showed a monster beat. This is the picture of a company that is firing on all cylinders, just crushing a spectacular holiday quarter. This is the fortress we're talking about. This is pure strength. Yeah, but it's not the only thing you see, is it? Now, I want you to drag your eyes over to the full year results on the right. What's that big number in parentheses? A net loss of $322 million. A massive reported loss. We're talking a loss per share of $2.30. So how on earth does a company that looks like an absolute world beater in Q4 end the entire year with that much red ink all over the page? A strong quarter is great, don't get me wrong, but it can't just paper over a deeply, deeply challenging year. And that number, that negative $322 million, that is the first major crack you see in the facade.
And that is exactly the right question to ask. To understand that massive contradiction, we have to deconstruct this business. We need to go past the shiny headline numbers and look at the actual steel framework that's holding this entire structure up. So it's time to go into the engine room. And for Hasbro, that means one thing: the Wizards of the Coast and digital gaming segment. This is where all the power is being generated.
And this slide right here lays it out perfectly for you. So in the fourth quarter, Hasbro as a whole brought in about $1.4 billion in revenue. Now look at how that breaks down. Consumer products, the toys, did about $800 million. But Wizards of the Coast, they did $630 million. Let that sink in. It's nearly half the company's total revenue in the single most important quarter of the entire year. This isn't just one part of the business anymore. You have to understand, it is rapidly becoming the business.
And it's not just about the sheer size, it's about the velocity. This is what's really incredible. Check out the growth rate on this slide. The consumer products division grew by 7%. That's fine. It's okay for a mature business. But Wizards of the Coast, it grew by 86% year over year. That's not just growth, that's an explosion. This is a high-performance engine running up full throttle, and it was powered by absolute blockbuster releases, like the Magic the Gathering crossover with Lord of the Rings.
Now this number right here, this is the one that should make every single investor just stop and take a very long look. 45%. That is the operating margin for the Wizard segment in the fourth quarter. It is a cash printing machine. You simply do not see margins like this in the traditional toy business. You see them in high-end software companies, in luxury goods. This is the kind of profitable, high-margin foundation that you can build a genuine fortress on. This is what we call institutional-grade quality.
So the crucial question is, how did they get there? Because this wasn't some kind of accident or a one-time fluke. This slide breaks down that margin performance. And what was the biggest contributor? a 22-point improvement from something they call volume and mix. So what does that mean in plain English? It means they sold more of their most profitable products. This isn't just luck. It's a clear sign of incredibly strong operational control and phenomenal brand power. They are selling what they want to sell, at the margins they want to get, period.
And you have to realize this isn't just a one-time surge. Let's look at this slide and see how this whole thing builds. This is the release schedule for their flagship brand, Magic. Just look at the collaborations they have lined up. Final Fantasy, Marvel, Fallout, Assassin's Creed. They are systematically turning Magic the Gathering into a platform for the biggest, most beloved intellectual property in the world. This is a durable, forward-looking strategy. It's a pipeline that is specifically designed to keep that high-performance engine firing for years to come. If you're a bull, this is your entire case on a single slide.
Hang on. A V12 engine is completely worthless if it's bolted to a 10-ton block of concrete. You can sit here and celebrate that engine all you want, but we need to talk about the anchor. It is time to inspect the deep and frankly growing cracks in the consumer products division, the legacy toy business that, let's not forget, still makes up a huge part of this company. And this chart just illustrates the problem brilliantly. Look, this isn't some Q4 snapshot. This is the full year performance. For all of 2025, that Wizards engine grew by an incredible 45%. At the exact same time, the consumer products anchor shrank by 4%. So you have one part of the business in hypergrowth mode, and the other is in active decay. The real question is, how long can one pull the other forward before that engine just completely stalls out? And the decay isn't just on the top line, not by a long shot. Let's look at the full year profitability, adjusted for all the accounting noise. We just saw Wizards post a 46% operating margin for the year. Fantastic, world class. Now scan down that table and look at consumer products. 4.6%. No, that is not a typo. 4.6%. It takes them 10 times the effort to generate the same relative profit. This segment isn't just underperforming, it is a massive drag on the company's overall financial health and its valuation in the market. And let's dig into the why, because this part is absolutely critical. What's causing this terrible margin performance? Well, the report tells you clear as day. Look at the text. FY margins impacted by lower revenues and tariff impact. Let me translate that for you. Their sales are going down and their costs are going up. These are not temporary, easily fixable problems. This is a structural headwind. So this isn't some minor crack you can just patch over with a bit of paint and hope no one notices. This looks a lot more like rot in the very foundation of the business. Okay, I'll concede the point. The legacy business has serious structural issues. Nobody here is denying that. But the key question for any investor has to be, what is management doing about it? Are they just ignoring the rot and hoping for the best, or are they actively tearing it out and reinforcing the entire structure? And the evidence we have shows they are engaged in a massive company-wide renovation project specifically designed to shore up those defenses. Let's start with what they can directly control: inventory. Take a look at this chart. In just a couple of years, they have managed to cut their owned inventory by 62%. That's from $677 million down to $260 million. This is proof of some serious operational heavy lifting. It improves the balance sheet, it improves cash flow, and most importantly, it shows you have a management team that is disciplined and laser-focused on capital efficiency. They are cleaning house, and they are doing it fast. And they're not just cleaning out the warehouse, they are fundamentally rebuilding the entire cost structure of the company. Management has laid out a very aggressive multi-year plan to find $1 billion in gross savings. As you can see right here, they're already making solid progress. They delivered $175 million of that in 2025 alone. The goal here is crystal clear: systematically trim the fat from the organization in order to strengthen the corporate muscle. Okay, the cost cutting is definitely happening. I'll give you that. And yeah, that cash flow number looks pretty solid at first glance, $893 million for the year. But you have to ask the next question. Where's that cash actually going? Are they reinvesting it to try and fix the broken parts of the business? Well, the slide shows they spent $225 million reducing their debt, which, that's good. But they also returned $393 million to shareholders through dividends. So is that really a sign of strength? Or are they returning capital because they don't see a high return way to reinvest it in that struggling toy division? To me, it feels more like they're managing a decline rather than funding a real turnaround. And that brings us right to the future. All of this restructuring, all this cost cutting, what does it actually translate to in terms of results? So let's seize on their outlook for 2026. Because this right here, this is where the market got really nervous. Is the company's guidance a credible blueprint for future success, or is it a flashing red warning sign for every investor watching?
Here it is. This is the number that caused all the concern. The official guidance for net revenues in fiscal year 2026 is, and I quote, up 3 to 5%. Now, just think about that for a second. We just saw the Wizards of the Coast segment grow by 45% for the full year. 45%. And the entire company, with that engine absolutely roaring, is only projected to grow 3 to 5%. That tells you everything you need to know about the incredible drag from the other divisions. The market saw this anemic forecast and immediately concluded that the anchor is heavier than the engine.
And look, this isn't just our interpretation. The financial press picked up on it immediately. This quote from Reuters gets right to the heart of it. The guidance was below estimates precisely because of the macroeconomic reality we're all living in. Consumers are pulling back on non-essential spending. And tell me, what's more non-essential than a plastic toy when you're trying to make ends meet in a tough economy? This isn't a problem management can just fix with an operational excellence program. It is a massive external headwind, and it's blowing directly against the absolute weakest part of their structure.
Okay, so we've inspected the engine room, and we've examined the heavy anchor that's chained to it. We've seen management's renovation plan, and we've seen the weak blueprint for the future that came with it. So now it's time for the final verdict. We have to weigh all this evidence and decide if an investor today is buying a solid, reinforced structure or if they're buying a house of cards that's just waiting for the next stiff breeze to come along.
Look, the bull case is clear, and it is powerful. You're buying a company that owns one of the best gaming assets on the entire planet in Wizards of the Coast. It has an incredible intellectual property moat, fortress-like margins, and a very clear path for continued growth. At the same time, you have a management team that is aggressively cutting costs, paying down debt, and improving operational efficiency across the board. They are doing the hard work. Essentially, you're buying the fortress, and they are systematically demolishing the rotting shack that's attached to it. But that shack is still attached, and right now, it's on fire. The bear case is that the drag from that legacy consumer products business is simply too great to overcome. The anemic guidance for next year tells you that the decline in toys is almost completely offsetting the boom in gaming. This creates a really dangerous reliance on a single engine. If anything, and I mean anything, ever sputters with Magic, there is no safety net. There's nothing to fall back on. And all of this is happening in a terrible macro environment for their weakest division.
So after all of that, it really all comes down to this one single question. Do you believe that the strength, the profitability, and the incredible growth of the Wizards of the Coast engine is powerful enough to pull the entire company forward and eventually transform it into that high-margin gaming powerhouse? Or do you believe the dead weight of the declining, low-margin legacy toy business, the anchor, is just too heavy and will ultimately stall out the engine and sink the entire ship? Are you betting on the engine, or are you shorting the anchor? The numbers are there. The structure is completely exposed. The choice is yours. Now go forge that portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.